Hi folks, and welcome back to Innovation and IP. This is the video series on commercialization part 2. And in this video series, we will be having a look at a stack of business planning stuff that you'll need to know before you launch forth and actually start thinking about negotiating your commercialization deals, or worrying about the impact of competition law on your commercialization deal. Those tasty snippets will be coming up in future video series. So business planning stuff today, and let's jump into the overview here. The way we're going to start this is, instead of looking first at the business structures, we're going to do some fairly fundamental groundwork in, what commercialization involves, the technical advances that are made at each different stage of the commercialization process, and the likely business decision making that's going to be involved at each stage. And accordingly, we'll also be looking at the kinds of funding that are available for each stage of the commercialization process. It's really important to have an understanding of, the broad landscape of commercialization and how it often unfolds, because it's really only once you have that understanding that you can then set about thinking about your business structure that you want to use to commercialize your widget, that is your innovation or your creation. Now, as per usual, I'll probably default to talking about inventions because that's usually what innovation will deal with commercializing. However, it equally applies to creations, the more creative arts. And for the creative souls among us, please don't feel left out. It's just the usual nomenclature that gets, kind of bandied about. So forgive my my invention-oriented discussion. So then we'll go ahead and look at the business structures, the kinds of structure that will best meet your particular needs or your client's particular needs from where they're at in the commercialization process and where they want to go. Finally, we will kind of segue nicely into our next video series coming up later in this unit, which will deal with negotiating a license or negotiating a commercialization deal by looking at the main distinction that is involved, and that is the distinction between assignments and licenses. So that's where we're headed today, folks. So without further ado, let us launch forth into the commercialization process. So, as you've probably worked out from your study guide, there are a number of different ways you can visualize the commercialization process. I've included a rather simplistic little diagram just because I guess it tends to break commercialization down into its major phases. However, please don't think that by me using that little simple flow chart as a heuristic for our discussions, that's actually what commercialization is like. You'll often see commercialization referred to as the commercialization pipeline, which makes it seem like a very linear process where you plug in the research at one end and then it chugs away, and then you do your development, and then you finalize everything, and then you spit the product out at the end, and hey presto, you've suddenly got a market and customers and all of that. Really, it tends to be much more messy than that, and often you will have a number of iterative stages where the technology will present challenges, and then you're thrown back to the previous step and you've got to problem solve to find ways and workarounds, and then it'll proceed back on track, and then something else, some other challenge will crop up. So it's really not as simple as that chart perhaps might lead you to believe. But what the chart is useful, as I said, is it just gives you a rough idea of the basic phases that tend to emerge, at least at some point during the commercialization process. And that's what I want to talk about with you here. Each phase really does involve quite different technology and business decision making, and I guess the most important thing for you to realize is that there are certain phases where funding changes the landscape quite significantly, and you need to know a little bit about how funding ties into the various different phases. As I said before, it's really only with this kind of understanding that you can then work out what your business structure really should be for your commercialisation process. So without further ado, again, let us punch on through to concept explored. Now in this phase, as you can tell, it's the stuff of blue sky dreaming, really. The innovator, be they inventive or creative, dreams big and then engages in a whole lot of scouting about in the literature, amongst their technical peers, using their own technical knowledge to work out what the best way forward is for or towards whatever it is they want to invent or create. At this point, business-wise, really, they're just making some very rough guesstimates about market and competition and so forth. Unless, of course, the invention itself is quite specific and in a fairly niche area that's well defined, in which case obviously your market is going to be relatively clear and so are your competitors. Funding at this stage, well, you don't really need funding to dream big dreams, do you? So the most investment here really will be just the innovator's time. Really same kind of thing here. You've just moved along incrementally towards probably what is really the kickoff phase, which is the next one. So you're continuing to refine your thoughts here so far as the technology is concerned. You're getting much further towards establishing technical feasibility. So you're starting to, really get your head around the literature, get your head around, what needs to happen with this widget, and you're making good progress on your testing and your research there. In terms of your business decision making, you're really looking much more closely at your market. You are trying to work out specifically your customer base and the size and shape demographic of that customer base. You're looking at your competitive advantage here, so facts that differentiate your innovation from the other things that are out there on the market that might substitute for this innovation. You are working out more particularly your value chain partners. So who are going to be your supply partners, who are going to be your production partners, who can help down the back end with dissemination and that kind of thing. So you're scouting about with perhaps a little bit more knowledge under your belt so you can be a little bit more specific. Funding, again, really, it's just the innovator's time and sleepless nights at this stage. Okay, so that's concept defined. Proof of concept really is where things start to get a little bit more serious. So you'll see sometimes the term proof of concept used in the literature. What that means, technology-wise, where it's a widget, is that your individual components are acquired and tested, and you've got sufficient data there so that you can model a potential range of performance and components when they're combined. So your technology here is fairly sound in what you are proposing. You've got enough data there to show you have a fairly feasible product. Okay, so business-wise, you're doing your SWOT analysis, strengths, weaknesses, opportunities, and threats. That's Porter's analysis there. So you're looking around in much more detail, a little bit more seriously at exactly how you can make this business work. The known and the assumed inputs are made clear. Obviously, that's going to have supply chain implications and the need for, obviously, protection of IP. So you've got to work out what parts of your widget can be protected by IP or are already protected by IP, and how you want to protect them moving forward. Okay. By this stage, a business model and a financial plan should be prepared, obviously, and that flows on necessarily, doesn't it, from making decisions about IP? Because if your IP, if you want to be making this widget open source, then your business model is going to be very different than if you want to make this this IP something that you can monetize. Okay, you should have your pitch ready. Okay, so you're going to need to be pitching to investors at this point, at proof of concept. This is really where the game kicks off. Okay, funding. This is really obviously because you're going to be looking at protecting your IP. And IP is very expensive to protect if you're talking about patents, certainly, and particularly if you're talking about globally patenting a widget. You're going to need some serious coin. Who's going to give you serious coin at this stage of the game? Well, unfortunately, not too many people. And as you can see right down the bottom of the slide there, I say this is where the startups are fighting their way valiantly through the valley of death. There is a funding paucity here. And the most reliable investors are what we call bootstrap investors, and that means you pull yourself, you know the old phrase, you pull yourself up by your own bootstraps. You know, you get your shoes on, you get out there and you get it done. Bootstrap investors are usually family, friends, associates, people that you can hit up for a bit of cash that might actually float you along until you can get some more serious, more reliable, more long-term funding. If you've kind of come to the end of your bootstrap investors and you need cash, proof of concept is kind of the earliest stage that angel investors might get on board. You might find them interested earlier. It really just depends, obviously, on the widget, but usually, obviously, if you can show proof of concept, you're going to be in a much stronger position to pitch to angel investors than if you're still kind of dreaming the blue sky dreams. Angel investors are a very specific kind of investor, and usually they are high net worth individuals. They are often from the tech startup community, so they've often been business entrepreneurs themselves and very successful at that. And they often have a great personal interest in mentoring others to tread in their own path. And so angel investors normally, because they're reasonably personally involved, they stump up their own money. They will want to be reasonably involved with the business that they are going to be assisting. So often they will want a seat on the board, and they will want to be quite involved with operational matters. So that's angel investors. They're going to look at whether the business can make money, obviously, first and foremost, what your competitive advantage is. So as I said, it's important to do your Porter's SWOT analysis and do it very carefully. What often tends to happen at this stage is you'll get an inventor pitching to angel investors, and they'll pick a figure out of the air. We expect that this widget can capture at least 3% of this market, and this market's worth hundreds of billions of dollars a year, and we expect to be making money within 12 months, 18 months. And you can't just pluck figures out of the air like that, unfortunately. You need to do a little bit more analysis and, as I said, do your SWOTs and show the investors that you actually have a fairly lucidly thought out path forward in terms of making some money. So you're showing your competitive advantage, you're showing that you've done a lot of work on looking at market size, as I said, demographics and so forth. You will want to show a great leadership team, obviously, and most importantly for the investor, an exit strategy. So they will want to know at some stage how they can get out and how they can get their money back. Angel investors will want to make a fair amount on the deal because this is such a risky investment, as you can imagine. There is no actual proof of application at this point. It's just proof of concept. So you've shown on paper this thing sounds pretty feasible. You might have done your homework very, very well, but that doesn't take away from the fact that it's still a very risky enterprise. And, you know, as I say down the bottom there, about 90% of startups don't get past this particular hurdle. So the angel investor is they're going to be very picky and choosy about who they select to back at this early stage. And you, as I said, you're going to have had to have done your homework. Sometimes this kind of funding is called pre-seed funding, or you might see it referred to more specifically as proof of concept funding. As I say, they're usually fairly small bucks at this stage. No one really wants to open their purse too far for something that's this risky. So 20 to 50 grand is about the max that you'll get at a pre-money valuation of, you know, $500,000 or less. For definition of those terms, have a look in your study guide. But pre-money valuation is just the, you know, the rough back of the envelope figure that an angel investor thinks that your company is going to be worth, or your entity is going to be worth, before they pump their money into it. Generally speaking, you won't get VC venture capitalist funding at this stage. It's just too risky for them. So that's proof of concept. This is really, as I said, where the game kind of kicks off. The next is proof of application, and this is further down the track. So you've done further work on the widget, and you have determined after testing how the whole system operates, okay, how it can actually be applied in practice. The results of your testing there provide the input data that you will need to further develop the widget and get to the ultimate most viable design for your prototype project. That's next stage on. In terms of business decision making at this point, you're going to be looking for critical success factors. So you've not only worked out that you've got this great technology, it looks good on paper, you've got your proof of concept, you've now also well on your way to prototyping things, and you're working out, okay, you're gradually narrowing down, okay, these are the precise things that we're going to need in order to move this, this widget forward. And so you'll need here evidence of scalability. What's scalability? Scalability is the prospects that a technology will be amenable to larger scale production and therefore bigger bucks at the end of the day. You might start bringing on some employees here, and you're going to be doing an awful lot of hard running in terms of getting some traction. You're going to be making a lot of business pitches, and you are really going to be selling yourself out there in the marketplace, trying to establish your widget out there. So you're getting your IP squared away, and this is where you're going to need to have the cash actually in your wallet to fork it out to pay for your IP protection. So funding, and this is where you can see things are really getting at crunch time here, because you're going to have to be shelling out those bucks for the IP protection. You're going to have to start shelling out bucks for paying your employees, moving the whole thing forward, keeping momentum. But normally at this point, you're still limited to bootstrap and pre-seed investment by your angels. So this is really the pointy end of the valley of death here. You might find, just depending on how appealing your widget is, that some early stage VC funding could appear on the horizon, but as I say, they're probably still in the valley of death. So if you manage to squeak your way forward but not yet out of the valley of death, you will arrive at product validation. And here we have pretty reliable evidence that your product, so it's gone from just a concept, proof of concept, to the fact that you can actually apply the concept in practice in real life. And then you've here got to the point of prototyping, and you'll often see it called in the literature minimum viable product, MVP. Okay, so you've got an MVP that you've been able to produce, and you've been able to get it out there to actually get some testing, okay, going by intended customers. Engineering scale-up specs are produced in order to be able to achieve demonstration project scale operations. Okay, so that's where your technology is at this stage. Critical success factors here for your business. You need to work out what you need to convince investors at this point that they should shell out enough money in order to, as I say there, invest in large scale demonstration project arrangements. You're going to have a firm business model here, definitely, and hopefully, because you're getting it out there, you're prototyping, you're getting customers, you're getting a supply chain organised, you should hopefully be starting to pay your salaries for your key members. Okay. Funding still at this point mainly bootstrap and pre-seed. You might, as I say down the very bottom there, find some early stage VC funding. Early seed funding might even be available if your widget is good enough. But you're probably at the tail end of your valley of death here. If you get to product validation and you've got an MVP, you are looking fairly strong for squeaking your way out of the valley of death. Finally, you get to operational environment. And once you can validate your operational environment, this is really where the gates finally creak open and you can apply for Series A funding. So at this point, your business really needs to be looking fairly tightly organised. You've got a very, very clear vision of where you want to go.
I was standing on the edge of my toilet, hanging a clock. The porcelain was wet. I slipped, hit my head on the edge of the sink, and when I came to, I had a revelation, a vision, a picture in my head. A picture of this.
You've got enough information, as I say, there resulting from construction, operation, production, use of the product out there in the market to justify that full-scale commercial production. And that, folks, costs a fair amount of money. So you're going to need to have things like intended customers lined up. As I said before, you know, you've got to be thinking about your supply chain upwards and downwards. So by upwards, I mean, who are your suppliers? Where are your inputs coming from? How reliable are they? Can you get contracts organised for all of that stuff? Downstream, you're going to be looking at dissemination. How are you going to do that? Who are your distributors going to be? How are you going to get the thing out to market? How are you going to market it? All of those kinds of consideration. It should be fairly clear to you by this point how all of this stuff is going to operate so that you can pitch successfully for a Series A funding round, and that, as I said, is where the gates will open for you. So you might find angels again are prepared to step in at this point, but early stage VCs are also open to this kind of a pitch. What is a Series A funding round? As I said down the bottom there, it's the initial offer of shares by the startup to those external investors. How are you going to value your shares, at what you're going to be asking? Generally, it's going to rely on your track record to date. Okay, how strong is your proof of concept? How strong is your proof of application? What's your MVP like? What's the initial customer reception? All of that kind of thing. Who have you got on board? Who's in your management team? What are their pedigrees like in business? Have they done this before? Have they not done it before? Is your proposed board, is it all full of academics who really don't know what they're doing? With all deference to the very rich seam of entrepreneurial academics we have in Australia, sometimes a board full of academics may not make for the best commercialisation team. So clear idea of market size here, and how the company is done with its seed capital. What progress has it made with its seed capital? That will all tell on an investor's decision as to whether or not they're going to jump on for a Series A funding round. Final design. So by this stage, you've got your design squared away. You've got most things technology-wise working very, very well. Business-wise here, your focus shifts somewhat, and you've got all of the information that you need to justify full commercial production. So that is as large an undertaking as it sounds. You're going to need to be thinking about where, so production facilities. You're going to need to be thinking about, again, bedding down all of your supply chain, upstream, downstream. You're going to need to thinking about employment arrangements with your staff. You're going to be needing to think about growing your market share, growing your management team. A lot of marketing at this stage. So real frenzied activity here, but at this stage you should be having a significant amount of growth. If you are in that happy circumstance, then Series B funding might be available. Again, angels and later stage VC investors may jump on board. Series B is really designed to support scale up. So remember I said scale up is getting the size and magnitude of your production process and your dissemination process increased to where it can get to in the marketplace, so that you're maximising your return for the investors. So there's traction with customers, companies earning income. Valuation is determined by your revenue, the assets including your IP, and your performance track record. And then, if you are lucky, you hit unicorn land, which is why I've got my favourite picture of rainbow butterfly unicorn kitty. If you get to this stage, you are doing remarkably well, and your technology is running away like a well-oiled machine. You've got market penetration increasing, sales going up. You've got justification, therefore, to ask for extra money to develop things further. So your Series C funding is all about getting the company bigger and grabbing as much of that competitive advantage and market share as it possibly can. So expansion, possibly acquiring other companies and gobbling them up in order to grow more quickly. Expanding overseas, potentially. You might be preparing for an IPO, initial public offering, and that is where you move from being a little company with a limited number of investors, a proprietary limited company, across to a publicly listed company that trades its shares on the stock exchange, and the public can buy and sell the shares. That is a very, very different beast and a much larger undertaking. So at this point, you might even be considering expanding into different and associated products and services. So your core business has gotten so big by this point that you're able to start exploring other potential avenues for expansion in different areas, different products, different technology. What might be associated, might not. So they are the various different stages in the commercialisation process. And I see that we are well and truly over our 20-odd minute mark for video 1. So I'll wrap it up here, folks, and skip across to video 2. Until then, bye for now, guys.